Forget your chart patterns, forget the economic forecasts. They are dust in the wind. If you want to understand why markets repeat their cycles of wealth and ruin, why man, time and again, builds the tower only to smash it down, you must abandon the ticker tape and look into the mirror. The technical man seeks to predict the future based on the past movements of the line. He believes that if he measures the wave, he can know the tide. This is a profound delusion. The greatest force in the market is not supply and demand. It is not the Federal Reserve. It is man's inability to change. The market is not a machine, it is a mob. It is a living record of collective human fear, greed, hope, and despair played out in real time. The delusion that this time is different is the single most expensive error ever made in the history of speculation. It costs fortunes. It ruins empires. It destroys men. When you abandon the belief that you are dealing with economics and accept that you are dealing with psychology, only then will the markets begin to yield to you. This is the single most important lesson I ever learned. It cost me millions to acquire it, but it made me hundreds of millions to possess it. Listen carefully. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The ticker tape changes names and prices. The railroads give way to the radio. The radio yields to the airplane. But the basic engine of the market, human nature, remains absolutely fixed. It is a constant. It is eternal. I realized early on that my successful trades were rarely the product of new information. They were based on recognizing the patterns of human behavior that had played out decades before, when men traded canals instead of copper. The what of the market, the company, the commodity, the bond, changes daily. But the why of the market, the emotional urgency, the panic buying, the stubborn refusal to liquidate, that is constant. It is the same engine. The speculator who attempts to learn only the new tricks of the trade without mastering the old psychology is a fool playing with nitroglycerin. He fails to recognize that he is not fighting a company's valuation. He is fighting the eternal soul of man. I spent years believing that if I could only acquire the perfect knowledge of a stock's internals, I could predict its movement. I studied the figures. I analyzed the statements. I read the news. All of it proved secondary. The ultimate movement, the true momentum that crushes shorts and bankrupts the longs, is driven by collective impulse. It is driven by the fact that under stress, people behave exactly the way they always have. They buy too high, they sell too low, they repeat the cycle without fail. The first principle of market success is understanding this. If you cannot recognize the pattern of human error from 40 years ago, you are doomed to repeat it yourself today. All destructive trading decisions, when you trace them back to their origin, are ultimately traceable to the reign of two monarchs, fear and greed. These two impulses are the great architects of financial disaster. They are the reason for every parabolic rise and every vertical crash. Let us define them, not as moral failings, but as operational hazards. Greed is the impulse that commands you to hold on to profits too long. You have a handsome gain. Your system, your charts, or your common sense tells you the move is exhausted, the time to cash out has arrived. But greed whispers, "Wait, it will go higher still. Why take 10 points when you can get 20? You sit. You watch your paper profits dissipate. You allow a glorious certainty to dwindle into an agonizing uncertainty. Greed turns paper gains into real losses. You end up breaking even, or worse, losing capital that should have been secured. Greed is the ultimate betrayer. It promises everything and delivers regret. Fear, conversely, is the sudden cold dread that strikes when a sound position experiences a necessary temporary retraction. You bought a stock based on clear reasoning. It begins to move in your favor. Then the market has a natural correction. The price dips 5 points. Fear grips you. You panic. You see your small profit dissolving or your small loss growing. You liquidate the sound position because the immediate emotional relief of being out of the fire outweighs the potential long-term gain. Fear denies you the patience required to let a profit run. Fear and greed are the invisible hands that steer the average man. The successful speculator must develop an emotional scar tissue that allows him to execute decisions against these impulses. Greed must be met with discipline. Fear must be met with analysis. The market cannot hurt the man who is devoid of these two emotions. But since we are all men, we must settle for control, not eradication. The inability to accept being wrong is not merely a failure of intellect. It is a fundamental failure of character. Hope is the most expensive sentiment a speculator can entertain. The market provides immediate, unambiguous feedback. When you open a position and the market immediately moves against you, it is telling you, quite plainly, that you were mistaken. The average speculator does not listen. He does not take the small, swift loss. He hopes. He holds on to the position because he believes that soon the market will realize its error. He believes his assessment must be correct, and the price will rebound to vindicate him. He averages down. He buys more of a losing stock, hoping to reduce his average cost and hasten the day of his glorious recovery. This man is committing financial suicide by speculation. I learned early on, hope is the companion of the fool. The man who holds a losing position because he hopes it will rebound is neglecting the critical function of speculation, which is capital preservation. He is turning an intelligent risk into a desperate prayer. Hope prevents the necessary action, cutting the loss short. Discipline demands that you accept the loss, clear the slate, and wait for the next, better opportunity. The market punishes hope and rewards cold, instantaneous discipline. Never average down. Never send good money after bad simply because your ego refuses to admit a mistake. If the market moves against you, accept the judgment. It is not an adversary seeking revenge. It is an honest accountant providing the figures. If you are wrong, liquidate. Then wait. The individual speculator must develop an almost fanatical resistance to the intoxicating urge to join the masses. Resist the crowd always. Bubbles are not financial events, they are social phenomena. They are periods when large bodies of men suspend critical judgment in favor of collective enthusiasm. They are defined by the infectious belief that if everyone is doing it, it must be safe, profitable, and true. When everyone agrees on an outcome, when the papers are screaming about easy money, when the bootblacks and the taxi drivers are offering you stock tips, the price has already been paid. The move is done. The crowd believes that safety lies in numbers. In the market, the reverse is true. Financial ruin lies in numbers. Success requires mental isolation. It requires the ability to stand against the stampede, even when the stampede is trampling over mountains of gold. It takes immense courage to be fully long when the world is screaming short. It takes even more courage to be entirely out of the market when everyone else is reaping fortunes. But the moment the consensus is reached, the moment you hear that every man on the street is talking about the stock you hold, it is time to get out. The moment has passed. The public has arrived, and the public always arrives late and pays top dollar. The crowd provides noise, they provide momentum, but they rarely provide the profitable exit. The speculator must be an observer, detached from the emotional fever of the mob. You must be isolated enough to think clearly, to ignore the clamor, and to wait for the inevitable moment when the mob panics and rushes for the same narrow door. Believing you are smarter than the market is the definition of arrogance. It is hubris. The market is an aggregate of all human stupidity, yes, but it is also an aggregate of all available human knowledge, collective desire, and brute force capital. No single person can conquer collective psychology. The moment a speculator begins to personalize his losses, when he feels the need to get even with the market or to prove his hunch correct, he has surrendered to his ego. And the cost of ego is ruin. I can trace nearly every catastrophic loss I ever suffered back to a moment of supreme arrogance. I believed I understood the situation better than the collective price action suggested. I was impatient. I was stubborn. I refused to let the market teach me. The market does not care how smart you are. It does not read your books or review your degrees. It cares only about the reality of price action driven by collective human opinion. If your trade is soundly based on objective observation but the price moves against you, you must defer to the market's judgment. You must assume that your information was incomplete or your timing was premature. The arrogant man attempts to fight the tape. He believes his will can overcome the collective will of millions of participants. He learns quickly that the market is impersonal. It is a vast, cold mirror reflecting his own lack of discipline. You cannot force the market to recognize your genius. You can only wait for the market to validate your patience. Hubris blinds you to objective reality. It keeps you in a losing trade far past the liquidation point. It pushes you into over-leveraged positions simply to prove a point. Leave your ego at the door. If the market humbles you, pay the tuition and learn the lesson. Human nature demands constant action. We are creatures of nervous energy. We feel productive when we are doing things, buying, selling, researching. But speculation demands rigorous patience. Most market errors stem directly from the impatience to wait for the proper setup. The amateur believes he must always be active. He feels guilty if his capital is sitting idle, earning nothing. He wants quick money. He wants the excitement of action. This desire for immediate activity is a psychological weakness that the market exploits through noise, minor fluctuations, and false signals. The difference between speculating and gambling lies precisely in patience. Gambling is acting out of necessity or out of the simple desire for the rush. Speculating is waiting for certainty. It is the arduous process of sitting idle, often for weeks or months, watching the tape, doing nothing at all, until the stars align and the setup presents itself with unambiguous clarity. The big money is not made in the buying or selling. The big money is made in the waiting. I often held short positions for over a year, waiting for the psychological exhaustion to set in, waiting for the distribution phase to complete before the true vertical decline began. Patience is not inaction. Patience is focused, disciplined observation. It is knowing that money is made by sitting, not by trading frequently. When a truly strong move presents itself, the market will tell you with authority. You do not need to hunt for minor profits in the noise. The moment is rare, but when it arrives, you must be ready. If you are constantly buying and selling, you are not speculating. You are simply paying the broker. You are feeding your need for emotional stimulation, and that stimulation is expensive. Master the art of doing nothing. Crashes are not fundamentally different from booms. They are simply the emotional mirror image of a boom. The desperate urge to liquidate is merely greed inverted into intense fear. When a boom is underway, greed makes men irrational. They feel compelled to buy at any price because the fear of missing out, the fear of future regret, is overwhelming. They buy blindly. The price rises beyond all logical measure because the psychology is driving the valuation, not the fundamentals. Then belief gives way to doubt. A small tremor occurs. Perhaps a dividend is cut or a prominent figure sells off. Suddenly, the fear of losing the enormous paper gains that greed helped acquire overwhelms the hope of further profit. This fear is just as irrational, just as impulsive, as the greed that preceded it. The public begins to rush for the door. They sell, not because the company has failed, but because they fear the price will fall faster than they can exit. This emotional cascade is predictable because the psychology driving it is pure human instinct. In a crash, men do not think. They simply react. The first sale is driven by fear. The subsequent sale is driven by the fear of the first man's fear. The speculator who understands the panic cycle knows two things. First, that the crash must be swift and brutal, because collective fear is more powerful than collective greed. Greed is a slow, steady pull. Fear is an explosive, chaotic blast. Second, the crash always overshoots the logical bottom, just as the boom overshoots the logical top. Emotion, not reason, dictates the turning point. The only lessons that truly stick in this business are the ones paid for in cash. Theoretical knowledge is cheap. It sits in books, gathering dust. It is easily discarded the moment the real pressure begins. Experience is essential because it anchors theoretical knowledge to emotional pain. I paid millions in tuition to learn self-control and humility. Those early losses were not mistakes. They were necessary investments in my own education. I learned far more from being ruined twice than I ever did from my early successes. The market provides the world's most expensive college education. When you lose capital, you feel it. That sting, that deep regret, that is the glue that makes the lesson stick. You learn, under financial duress, precisely how you behave when you are afraid or when you are arrogant. You may read 1,000 times, cut your losses short. But you do not truly internalize that rule until you have watched a small, easily managed loss swell into a devastating sum, because you let hope stand guard over the position. Wisdom in speculation cannot be borrowed. It must be earned. It must be earned by witnessing your own emotional reactions under fire. You must see your greed manifest as stubbornness. You must see your fear manifest as premature liquidation. You must understand your own psychological profile, and the only way to do that is to put capital at risk and see what your gut tells your hand to do. The true cost of this business is not the capital lost. It is the emotional pain required to transform a gambler into a disciplined speculator. Do not trade the event itself. Trade the reaction to the event. The news is public. The financial statement is printed. The general sentiment is broadcast. None of this changes the price in a predictable way. The market has already discounted the information. What truly matters and what reveals the current psychological state of the majority is how the public reacts to the news. This is trading the human element in real time. For example, a company releases undeniably good news, excellent profits, increased dividends. If the price barely rises, if the stock shows no immediate, powerful reaction, what does that tell you? It tells you the public's enthusiasm is exhausted. It tells you the major players have already bought all they intend to buy. Good news is being received with apathy. That is a sign of weakness. Conversely, imagine bad news breaks, a profit warning, a product failure. If the price dips only slightly and then holds firm, refusing to fall further, what is that telling you? It suggests that all the weak hands have already liquidated. The bad news is being shrugged off by strong capital. This indicates a high level of psychological resilience and underlying strength. This is not technical analysis. This is reading the public mind through price action. The seasoned speculator doesn't concern himself with the quality of the news. He concerns himself with the temperature of the market's response. Is the public reacting with wild enthusiasm, indicating a top? Is it reacting with abject panic, indicating a momentary bottom? Is it merely bored? The market is always speaking. Its voice is the aggregate response to events. Learn to listen, and you learn to understand the collective psychological state. The single most important lesson I ever acquired is that the market is merely an expensive way to teach you self-control. The market is the battlefield. But the battle is internal. It is 10% market analysis, knowledge of the system, and timing. It is 90% psychological discipline. The greatest challenges you face are not external forces like central banks or crop failures. Your greatest enemies are sitting right inside your own head. They are your hope that refuses to liquidate a losing position. They are your greed that keeps you holding on to a profit until it vanishes. They are your ego that demands you prove the market wrong. If you cannot conquer your own fear, your own greed, your own hope, and your own ego, you will never, ever master the markets. Every decision you make must be divorced from feeling. You must become a ruthless mechanic operating a set of rules. If the setup arrives, you buy, without excitement. If the stop is hit, you liquidate, without regret. If the conditions require that you sit idle for 6 months, you sit idle, without impatience. This psychological separation, this cold, hard objectivity, is the speculator's only reliable advantage against the emotional mob. The market is designed to reward the disciplined few and punish the emotional many. It takes everything you have, and then it takes your character if you allow it. Guard your self-control above all else. It is the only true capital you possess. When you understand that every financial bubble and every catastrophic crash is simply a recurring manifestation of the same old human greed followed by the same old human fear, you cease looking for the secret indicator. You cease trying to predict novel outcomes. You start looking at yourself. The market never changes because humanity will never change. The speculators of today hold the same hope as the speculators of the 1890s. They suffer the same fears. They make the same costly errors. The single most important lesson is that there are no new lessons. The principles are eternal. The speculator's job is simply to observe the unchanging face of humanity reflected in the price action and to act without emotion. Control yourself and you control the market. That is the truth. To truly learn from a master's mistakes without paying the $1 million tuition fees yourself, there is no greater tool than immersing yourself in his story. Edwin Lefebvre's timeless masterpiece, Reminiscences of a Stock Operator, is more than a book. It is the closest thing a speculator can get to a flight simulator for the human mind. The wisdom you have just heard, the painful and expensive lessons, were all drawn directly from this incredible work. In its pages, you do not just read about Jesse Livermore's triumphs and disasters. You live them. You feel the gut-wrenching pain of his greatest blunders and the quiet, profound satisfaction of his most brilliant campaigns. For those truly committed to this deep study, we highly recommend the edition which includes a unique, detailed chapter-by-chapter analysis by Max Davidson. This analysis acts as your co-pilot, translating the century-old wisdom of the text into a clear, actionable roadmap for the modern trader, ensuring that the lessons learned in 1923 are as powerful and as profitable today as they were then. A link to this essential edition is provided in the description below.